Welcome to all of you. Myself E. Kalachelvi, Assistant Professor, Wales Institute of Science, Technology and Advanced Studies. Today I want to discuss about cash price by annuity method, cash price meaning, annuity method of depreciation, sum 1 and 2. Cash price. This is the retail price of the article at which they can be purchased immediately for cash. Second thing, the cash price might include other costs such as fees incurred for transportation or storage of commodity. The cash price may also be known as spot price. Annuity method of depreciation, that is the meaning of annuity method. The annuity method of depreciation is a process used to calculate depreciation on an asset by the calculating its rate of return, just as if it is for an investment. It is commonly used with the assets that have a large purchase price, long life and a fixed, open the bracket, or at least constant rate of return. This annuity method of depreciation requires the determination of the internal rate of return and the cash inflow and outflow of the asset. The IRR is then multiplied by the initial book value of the asset, and the result is subtracted from the cash flow for the period to find the actual amount of depreciation that can be taken. Under this method, it is assumed that the amount spent in the purchase of the asset is an investment which should yield interest. The amount spent in acquiring the asset assumed as an investment and interest is charged at a certain rate of the diminishing balance of the asset, and it's debited to asset account and credited to interest account, which is transferred to profit and loss account. The asset is credited every year with a fixed amount of depreciation. The amount of depreciation to be charged every year is such as that in spite of asset being debited with the interest every year, the asset is reduced to zero or its residual value. The amount of depreciation is calculated from the ready annuity tables. The amount of depreciation will be different according to the rate of interest and the lifetime of the asset. The net burden on the profit and loss account goes on increasing year after year. This is because depreciation that is debited to profit and loss account is constant and interest being credited goes on decreasing year after year. When additions are made to the asset account, calculation have to be revised. This method is used in the case of leases having large amount of spread over a number of years. Merits. The amount of depreciation to be charged is ascertained from annuity table. Therefore, this method is scientific. This method provides for recovery of invested capital along with interest. This method is most suitable to such assets which require heavy initial investment. Useful method to use in respect to long-term lease, which generally involve considerable capital outlay. Interest on capital investment is taken into account. This method is received to the most exact prices and scientific form from the point of view of calculation. Demerits. Calculation of depreciation becomes very difficult when additions are made to asset. Calculation of interest is arbitrary. This system is not at all suitable for those assets which are of small value. Though interest is taken into consideration, but the rate is still arbitrary and not based on law. Computation using this method becomes more complicated where there are frequent addition, dismantling, etc. taking place, not now suitable for assets like plant and machinery. Sum number 1. On 1/1/1990, X bought some truck under hire purchase system for rupees 51,000, payable by 3 equal installments combining principal and interest, the latter being a normal rate of return of 5% per annum. Calculate the cash price. The present value of annuity of ₹1 for 3 years at 5% is rupees 2,723. Let's go into the solutions. Calculation of cash price. The present value of annuity of ₹1 paid for the 3 years at 5%. So the value of 5% is 2.723. Annuity factor. Installment equal to 51,000 divided by 3 because it is 3 years included. So the value is 17,000. The present value of annuity equal to installment into annuity factor, that is the formula. So the value you have to include 17,000 is the installment value into 27,325, that is the present value of annuity method. So you have to multiply the value of present value annuity method is 46,295.25. That is the cash price of Mr. X. So the final rate of value is 46,295.25. Sum number 2. On 1st April 2005, a manufacturing company buys an hire purchase system, a machinery for rupees 60,000. Payable by 3 equal annual installments combining principal and interest. The rate of interest was 5% per annum. Calculate the amount of cash price and interest. The present value of annuity of 1 rupee for 3 years at 5% interest is rupees 2.72325. That is the solution of this problem. The present of annuity of rupees 1 paid for 3 years at 5%. The 5% value is 2.72325. Then the present value of rupees 20,000 for 3 years equal to 2,72,325 into 20,000. The value is present value is 54,465. So the cash price is 54,465. Thank you.